The final rule is going to apply to most consumer mortgages, and the exceptions are, again, also kind of intuitive. HELOCs, home equity lines of credit, are not subject to the final rule. Reverse mortgages are not. They are still subject to the GFE and HUD 1. Mortgages that are secured by a mobile home or dwelling that is not legally affixed to the land, so you still have a land transaction and perhaps a personal property transaction, those are not subject to this rule. And then no interest second mortgage that's made for a down payment, some kind of bridge loan, things like that, those are not subject. And finally, loans that are made by a creditor who makes 5 or fewer mortgages in a year, also not subject to this rule. Next slide. So the effective date is on or after for all loans for which an application is received on or after August 1st, 2015. And there are a couple of exceptions, some provisions that actually go into effect that date whether or not an application has been received. So those provisions that are not specifically tied to an application. And the first is a lender is still restricted from imposing fees on a consumer before they've received the loan estimate other than the credit report, and has indicated an intent to proceed with the transaction. So that goes into effect August 1st, 2015, regardless of whether the application has been received at that point. And also, for a lender to provide, if they provide one of those worksheet disclosures, a written estimate of terms or costs, if they do that on or after August 1st, 2015, they must have a written statement that informs the consumer that the terms and costs may change. And again, that is in effect August 1st, 2015, regardless of whether the application has been received. There is no provision under the final rule for a staggered implementation date. So like we had in 2010, when some lenders actually sort of began using the forms prior to, I believe it was January 1st, if I recall, of 2010, does not provide for that. So this is only for loans or applications that were received on or after August 1st, 2015. So there were some wins, and we use this term when we talk about the extensive efforts that ALTA made when it was working with the CFPB and others in trying to make sure that the rule was crafted to the best of everyone's ability. There were some issues that were not adopted. The all-in APR was something that a lot of folks were concerned about. I think actually MBA did a lot of the heavy lifting on lobbying the CFPB and Congress for, actually it would be CFPB on this for the rule, making sure that the CFPB was listening to their comments about the all-in APR. So the all-in APR was not adopted. The proposed rule had some additional costs, such as title insurance to the finance charge, and that was not adopted. Also, the record-keeping provision. There was a proposed requirement that creditors maintain evidence of compliance with the rule in an electronic machine-readable format. And this was not included ultimately. Now, I do understand, and Ben may be able to speak a little bit to this more, but I do understand that the CFPB is still very interested in this. I think that there, if I recall, there is actually lenders are going to be submitting reports at some point. Ben, can you jump in on this? Because I'm not as familiar. I think there's a report that will be submitted after a time period, and at that point, the CFPB is going to be looking for lenders to say that they're prepared to maintain the records in this format. Is that correct? Am I correct about that?
Well, yeah, there are a couple of different initiatives going on here that sort of link up to the Bureau's original proposal to require that the disclosures be maintained in an electronic machine-readable format. And just to be clear, what was proposed was not that the disclosures just be retained electronically, such as in a flat, as they say, PDF document.
Oh, right. It was the data. Correct.
Yeah,
right.
It was the data. They wanted the data, and the idea was you should be able to, in an automated way, look at a loan from the first loan estimate all the way through the final closing disclosure and be able to see, what changed. This synced up. Ultimately, the Bureau did not adopt this. Part of this was because the Bureau has, been working with, as part of the, or looking to the MISMO project, the Uniform Data Standard, and the idea that basically the market and the GSEs would push folks in a direction without the Bureau doing so. And then also what's gotten a lot of attention, and I think Cynthia's referred to this, is the Bureau's e-closing project, which is a little different and is a project where the Bureau is trying to sort of promote the idea of being able to do electronic closings. They have asked for lenders to basically submit proposals to participate in their pilot project, but that's the voluntary effort that's going to be taking off in the fall.
And at this point, lenders really are not, many lenders are not really ready, if I recall correctly, to have that data retained in that format, and that's really why the CFPB chose to hold off on that, particularly in light, I think, of the implementation of some of the other rules. They wanted the lenders to be able to be prepared for that, and perhaps integration with settlement service providers too, with maintenance of this data. So there's still some, I think, quite significant efforts that need to be made in order to get everybody ready to be able to retain the evidence of compliance in this format. The final closing disclosure must be retained for 5 years after consummation by the creditor. Again, so these were issues not adopted. These were the record-keeping rule. Also, the approximate cost of funds box was eliminated. There was a box on if some folks were to have remembered this from the proposed rule, in the testing and in all of the preparation during the period after the proposed rule was put out, that was determined that consumers just simply did not understand the box of the approximate cost of funds.